Whenever you're ready, take it away.
Thank you, Robert. Good afternoon, everyone. My teammates, Luis Felipe Darraga, Hayao Suzuki, and myself, Lisbeth Walke, are representing the University of Chicago Booth School of Business. And today we're presenting our pitch on ARGO 6% bond with maturity in September 2027. Today we're gonna go over our table of contents. We have the executive summary. Then it will be followed by the company overview, our investment thesis, risk and mitigants of our trade, and finally, we will open the floor for questions. I'll hand it over to Hayao.
Thanks, Liz. And here's our executive summary. Buying this 6% ARGO bond due in September 2027, we also recommend to hold it to call with yield towards of 4.12%. We are expecting that the company would exercise a call option on September 2022 next year at the price of 103.0. We have three investment theses to support this trade recommendation. ARGO has a competitive advantage as a low-cost producer, especially in sugar and ethanol. And despite its dividend distribution policy, which they announced recently, the company has strong cash generation. Lastly, in its sugar and ethanol businesses, there are favorable commodity price outlook. Here is ARGO's financial snapshot. It has been improving gross margin and EBITDA, lowering its debt and EBITDA ratio. And I'll pass it again to Liz.
Thank you, Hayao. So ARGO is a low-cost agro-industrial company from South America with presence in Argentina, Brazil, and Uruguay. It was founded in Argentina in 2002, and it started its business as a farming company. Later on, it expanded its business to Uruguay and Brazil, and in 2010, it launched its sugar division as well. Currently, the company has three main divisions: Sugar, Ethanol, and Energy, or S&E division, which is a fully integrated low-cost producer in Brazil, in Mato Grosso do Sul specifically, and it has a high flexibility to switch production between sugar and ethanol following market conditions. Their farming division is mainly located in Argentina and Uruguay, and ARGO has a diversified farming business producing crops such as corn, wheat, soybean, as well as rice and dairy. Finally, their smallest division is the land transformation, which is focused on the acquisition of underdeveloped and undermanaged land to transform it into its highest productive capacity. The company has strong track record in land sales. We can see how these divisions contribute to the company's financial performance as of 2020. In terms of sales, the farming and land transformation divisions accounted for 52% of sales, while the S&E division represented 48%. However, if we observe the contribution to EBITDA, the S&E division represented 74% of the company's EBITDA generation, while the farming and land transformation divisions represented only 26%. In terms of their capital structure, the company has a total debt of 1.1 billion, which includes the revolving credits, term loans, the bond that we are pitching today, and other lease liabilities. They also have total common equity for 951 million. The company was launched in the New York Stock Exchange in 2011. They have total minority interest for 36 million and a total capital for 2.1 billion. I'll pass it on to Luis to talk about leverage and liquidity.
Thank you, Liz. Now I'll talk a little about the financial profile of the company. So that we believe is characterized by adequate leverage and liquidity metrics. So as you can see in the chart above, the company's net leverage increased over the past decade due to the investment plan of the company. And now as ARGO scaled down the investment plan, it's been trending down to 2.66 times as of 2020 and down to 1.8 times as of September on a last 12 months basis. And this also incorporates the strong performance of EBITDA of the last 12 months of the company. Now, going to liquidity, we can see that the company has an ample maturity profile with 5.2 years of average debt structure and non-material payments in the next couple of years of the non-current debt. Short-term debt, the company has around $200 million, which is manageable, taking into account that the company has around 190 million cash balance and also around 312 million of marketable inventories, and also taking into account the financial flexibility of the company that has access to credit lines and also to international bonds market. Regarding the debt currency breakdown, the company has a match within its debt in US dollars, which is around 80%, and its revenue and EBITDA generation that it's around 72%. And furthermore, the company also has an FX cash flow hedge in place. Finally, I will also add that the company has an average interest rate of 6.9% in Brazilian real and 4.3% in US dollars. I will hand it back to Liz to talk about a little bit the yields of the company.
Thank you, Luis. Here we have the historical bond yield for the company for the last 12 months. In August, the company reached a minimum of 2.86%. However, in most recent months, we have seen an upward trend. This bond, despite the company being first launched in Argentina, given that its most significant division, the S&E division, is mainly in Brazil, the bond moves accordingly with Brazilian assets. In the most recent months, we have seen concerns regarding Brazilian growth rate, their fiscal policy, as well as the upcoming elections for next year. This is what explains the upward trend. However, in most recent weeks, we have started to see a little bit more stability in Brazilian assets and some flows going into the country, which makes us think that the worst has gone through, and this could be a good entry point for the bond. We can also see that if we analyze Adecoagro against comparables in the industry, we have considered names not only from Brazil, but also from the region. Given that we cannot find so many comparables within the country, we looked in Latin American countries as well. However, the two main comparables we have included, which are Cosan and Raízen, are two agro-industrial sugar and ethanol producers from Brazil. We can see how Adecoagro has an attractive valuation, especially if we compare it to the BB bucket, considering that this is a BB bond. We can see that it's trading at a premium, which reinforces our thesis that it is a good entry point to gain exposure to the company. Our first thesis is the competitive advantage as a low-cost producer. We can see in the first graph how in their S&E division, Adecoagro has a cost of 7.9 cents per pound in their production, which is way lower compared to other countries, even to what we can see or we can find in Brazil. This advantage is explained to several factors. The first of it, it's because of its geographic location. In Mato Grosso do Sul, which is located west of Sao Paulo, the land can only be used for either cattle ranching or sugarcane production. And cattle ranching is not as profitable. Thus, the cost for leasing is decreased because of this. In terms of the continuous harvest, this area is less seasonal than other sugarcane producing areas like Sao Paulo. During the winter is more humid, and during the summer it's drier. This allows the company to have a continuous harvest during the year. Even in the off season, they can do it without having a significant impact on yields. The company also has its own energy production. Once they do the harvest of the sugarcane, they use the residue, which is the bagasse, to produce energy. 30% of their produced energy is used for their own production, and the rest is sold to the local community. Finally, as a fourth point, we have mentioned already the flexibility in their production mix. Adecoagro, and usually companies in the sugar and ethanol industry, can go up to 60 or 70%, either in sugar or ethanol production. However, Adecoagro can go up to 85% in ethanol and up to 70 to 75% of sugar, which gives them higher flexibility than other peers. And in last place, the company has a tax benefit in Mato Grosso do Sul, for the sales of ethanol locally. This compensates higher freight costs. The company is also a low-cost producer in its most important crops, such as soybean and corn. We can see this in the graph in the middle, where Adecoagro has a cost of USD per ton lower than peers in the US. Given all this advantage in cost production, Adecoagro is prepared to face different scenarios while maintaining solid margins. A good example of this is the company's results during the third quarter. During this year, we have seen how, especially the sugar and ethanol division has been affected by frost in Brazil. Despite this, the company managed to obtain a EBITDA margin of 15.9% in the third quarter. And if we look at the aggregated numbers for the 9 first months of the year, we obtain an EBITDA of close to 47%. Our second thesis is the strong cash flow generation despite the announced dividend policy. Adecoagro is currently ending a 5-year investment plan in which they invested 230 million per year. This is well above their maintenance capex of 120. Going forward, we expect capex to remain relatively stable at around 150 million. This is because the company has reinforced their position of only taking smaller projects within their existing business line, and they are targeting projects with an IRR of at least 20 to 25%. We believe that the company is going to be very strategic on how they allocate capital going forward. Furthermore, Adecoagro has recently announced their dividend policy. This was highly expected by the market. However, they have announced that they will distribute 40% of their adjusted free cash flow from the operations starting next year. Despite this, we believe, according to our projections, that cash flow generation will remain strong. The company is also committed to maintaining a net leverage ratio of 2 times. This is way below the bond's covenant of 3.25 times. Going forward, we believe net leverage will be relatively stable between 1.5 and 1.7 times. Now I'll pass it on to Luis.
Thank you, Liz. So the third thesis we would like to talk about is the positive momentum of the commodity cycle that will benefit the revenue and margins of mainly the sugar and ethanol businesses that, as Liz mentioned, generates around 74% of the EBITDA of the company. First, for sugar, the main drivers of this momentum are related to the supply. There's a decrease in supply for, same as Liz mentioned, the frost in Brazil. It has been affecting the main producer in the world, and therefore pressure having pressured upwards. And we expect that this trend will remain for 2022 as well. So as you can see in the chart, we're expecting sugar prices above 17 cents per pound, while the historic average was around 12 or 13. So this definitely it's an upside for the company, and actually today it was trading above 20. So there's definitely a good momentum for sugar. And regarding ethanol inventories are also down 5.4%, and demand is increasing as their economy reopens. So this also is very important for the company, and it's also somehow supported by the high oil prices at the moment. As you can see in the other chart, we can see kind of the production mix between sugar and ethanol. And as Liz mentioned, the company has a lot of flexibility in here to adjust depending on the cycle of both business segments. And that's also something that we believe is great positive. So with that said, I will hand it back to Hayao to talk about the risks and mitigants of the credit.
Thanks, Luis. So at the end, we want to cover some risk and they have and the mitigants. We found 3 major risks: unpredictable weather conditions, fluctuation of commodities, and the regulatory risk from government. Those risks are the agro company or company in Latin America commonly have. However, Adecoagro has been dealing those issues quite well. As for the weather issues, Adecoagro faced low competition for land use in main location in Brazil, which allows them to take various measures to offset the impact of weather impact causing the lower yield. And for commodity price, Adecoagro has a well-defined hedging policy and continuously monitor the market condition to find the best timing to take hedges. So for example, 2020 to 2021, they only had 40% against their 75% of hedges in their competitors, which gives them the better exposure to the rising prices. And finally, regulatory risk. In the scenario, a price of the control on the fuel in Brazil happens, the company has flexibility in its production mix to increase the production of sugar and then export it to the international market. So in that way, so they can manage their some changes in regulatory or regulations in their country. So they have been facing risks, but they are doing quite well. So that is the end of our presentation, and we are happy to answer any question you might have.
I can start. Do you have a sense of what the FX currency mismatch might be? Because most of their debt funding's in US dollar, as you talked about. I understand it's commodity, but I'm not sure sugarcane and ethanol, corn is traded in dollars, because obviously all their costs are local. So I was wondering if you have looked into that. I didn't see it. So.
Yes, so here we have a bit of how the sales are done, are distributed per market, and 72% of their sales are done in international markets and are mainly in US dollars. Considering they have 80% of their debt in US dollars, as Luis mentioned before, we consider they're pretty much matched, considering this numbers we are presenting.
No, thanks.
I guess maybe you can talk a little about their, I think you have some of it on here, you've got 3 sugar ethanol mills, I think it says. I guess can you talk about like experience with potential any issues at any of those mills, given the amount of cash flow and EBITDA that comes from presumably those few facilities? Have they had downturns? Do they have any protections against issues that they're just being so exposed to those few facilities?
So actually the company's strategy was to create clusters. That way they can have a more efficient production and in terms of cost. So that is why they have these 2 mills that are relatively close to each other, and their plantations of sugarcane are located in between them. This in general has allowed the company to reduce costs, but also during their 5-year investment plan, they have done improvements in their facilities to make them top of the line, which I also believe that also helps face different scenarios. And as we mentioned before, will help the company even under scenarios where commodity prices go down. They already have a very cost efficient system in place.
I guess maybe what sort of utilization do they typically operate at, and in the event that one of their 2 mills experiences a problem, how can they pass on production to another facility without impairing the overall credit profile?
Yeah, so in general, compared to other peers, Adecoagro has close to 20% higher crushing throughout the year. This is because of their continuous harvest. So while other companies cannot crush as much as during the off season, Adecoagro can kind of expand their crushing period throughout the year. I think that helps with having, even though they have a higher crushing time, this also contributes to lower costs as they have economies of scale. I'm not entirely sure how they would arrange themselves in one of the mills would not work. I know that they have maintenance schedules throughout the year so that they can ensure that this doesn't happen. But I'm not completely sure what is their contingency plan. We could definitely dig more information on that.
Yes, we could dig further. I would just add to Luis' answer that the fact that the company hasn't announced that they are going to scale down their investment plan implies that they feel comfortable with their capacity at the moment, and they might be able to offset some downturn. If it's not that severe, obviously we can dig further to see what could be the impact of one full mill going out of service.
Guys, how do you think about fertilizer costs, and how much of a percent of total costs is fertilizer costs?
Yes, so fertilizer costs have indeed been going up. And that is something that the company in the most recent earnings presentation has addressed, that they are looking to ways of hedging this cost or searching for more natural or options or more cheaper options going forward. I believe that management is currently working on that. So given their track record, and especially them having a sustainable business model since the beginning of the company, I would say that even if fertilizing prices go up, management will do a good job at offsetting these increases in the future.
And then just one more, if you go to the yield chart, yeah, just visually, it almost just looks like a reversion to the mean. What gives you confidence that this is not the case?
I would say basically because this is a bond that has a call option in just the coming months. Actually, the call option is in September 2022. We believe that that 4.12% of the current yield that has not, and this upward trend has not been given companies fundamentals. We believe that as Brazilian assets start recovering, which we are starting to see, companies with solid fundamentals will be the ones that will be more benefited by this context. We have started seeing that in investment grade names. ARGO is a high yield bond. However, it's one of the most strong companies between the high yield universe in Brazil. So that is why we believe that that 4.12% yield for that 0.8 duration that the bond has to call is a very attractive yield to gain exposure to a company in Brazil.
I guess just real quick on this, but the bond's already trading to the 22 call. Market seems to be pricing that in. What over the next less than a year timeframe here? You outlined a handful of risks here, but what are the key issues that could derail and change the market perspective of this being able to be called?
Yeah, so obviously because of the exposure the company has to commodity prices, if there were to be a downtrend in sugar that comes like before than we expect, because we see sugar prices starting to go down just in 2023, but if that would happen during 2022, that is definitely a risk factor. I would say the other important factor would be the presidential elections that are in Brazil next year. And we mentioned a little bit of this, and the sector that would be most impacted would be ethanol. Just a few weeks back, Bolsonaro mentioned how he thought fuel prices were very high in Brazil. This obviously responds to oil prices internationally, but that gave a little bit of uncertainty regarding if he is reelected, would he put like cap on prices of fuels locally? So that is definitely a risk that we could see if, for example, Bolsonaro was reelected. However, as we mentioned, if this were to happen, we have two mitigants, which would be increasing the production of sugar in the mix to be still benefiting from the high prices we're still seeing in sugar, but also their tax benefit that they have in Brazil, in Mato Grosso do Sul. It was awarded by the local government. And this tax benefit is independent from what happens nationwide. So it's a 9% tax benefit, and that is approved until 2032. So they will not lose that tax benefit, even if there is a change of government in Brazil. So that is also another mitigant we consider as risks for the company. In terms of Argentina, because they also have the farming business that is also located in that country, the most potential risk would be higher export taxes. We have seen that in the past, Argentina has increased taxes for beef exports, but we cannot say that this won't happen for crops as well. So we would be monitoring if the country gives signals that they are analyzing any increase of export taxes on crops. At least in the near term, we do not see them. We have not seen any further signals of export increases in Argentina, but that is definitely another risk that we should monitor for the company.
Right, any other final thoughts here before we deliberate? All right. Oh, thank you, Booth. Great pitch, and thank you again, judges. So
Thank you.
at this time, we will take everyone into the main room, and judges, we will put you